let's bring in another voice to this, and that is Marko Kolanovic of JPMorgan. He has been obviously well known to our guests here on Fast Money. And Marko, we're glad to have you back on the program, Macro Strategy Global Head. Looking at your latest notes, and I mentioned the sort of the coronavirus data, I would almost say that Johns Hopkins data is the new jobs number in a certain way, if you know what I mean. For me anyway, looking at this data, what are you looking at most closely to try to figure out what is probably almost an impossible situation to figure out?
Thank you. So as you mentioned, I think the virus data is now key. I mean, when it comes to economic, in normal times, they are very important. But right now, the economy was basically closed. It was closed. So we know that these data are going to be abysmal. So the question is, can they jumpstart one when the virus subsides and when we open the economy? And for that, you need to know when will you be able to do that. And for that, you look at the virus data, not the sort of claims data or retail sales. We know that they're to zero if people are locked in their homes by the order of government. So virus data, we started looking at the sort of big data, especially smart thermometers. About 4 weeks ago, there's a provider of smart thermometers called Kinsa, and they're basically publishing daily, which is pretty much a real-time influenza-like symptoms across the U.S. So we look at the data first. We saw very early on that disease is spreading, and as soon as the measures for social distancing were announced, these typical influenza illnesses started dropping very, very quickly. And so we could model daily increase, we could model daily decrease, we could model recovery, of people. So mild cases about 2 weeks, serious cases 3 to 5 weeks. And we saw sort of early on that this is better. And obviously, you want to market yourself with the, New York State press conferences in the morning, late morning. You want to basically see net hospitalization. You want to see sort of, a few other data points, obviously fatalities, and which do lag, and also intubation. So our model is basically tracking to New York State data. And we were already 2 weeks ago, we said Apex is going to happen a week ago, and we are getting actually now, and when I say apex, that's basically net hospitalization growth inflection. I know it sounds a little bit convoluted, but that's basically when you stop accelerating pressure on a hospital and start decelerating. That happened already about 7-8 days ago.
But Marko, I'm fascinated. Sure. Marko, I'm sorry to jump in. I'm fascinated by all this stuff, but I need to tie it back to what we do here. What does it mean for the market, the stock market? Okay. Tie that to equities, the economy.
Exactly. So that means that we think it's going to be possible to reopen it sooner. We think within a week from now, you will start seeing some limited moves. A little bit like what you're seeing today in Germany, announcement for Monday. We think we're not too far behind. We think we're weak. It's a week away from it. It's going to be limited. I'm talking baby steps, but that tells us that sort of by the summertime, we may more substantially recover. And sometimes next year, maybe in the second half of next year, economy reaches a high watermark, which means that the market could reach a high watermark in the first half of the next year. So that's basically the timeline that we expect.
So Marko, thanks for being here. It's Guy. So a lot of this assumes, I would think, that once people feel that we're somewhat out of the woods, things go back to normal, absolute normal, where we were 3 or 4 months ago. I'm hard-pressed to come up with a situation or a scenario where that takes place.
Yeah, no, we're not talking about normal. Some things will change forever. I think some restriction measures and some control measures, for instance, checking the fever, I think that's going to become a new normal. You remember September 11, traveling in air before and after, we all get used to basically being checked, get sort of name tags in the buildings, pictures taken, our luggage gets searched. So we get, so I think we're just used to some of these things, like, for instance, like a temperature check, fever checks. And I think it just makes a lot of sense. And I think when we get used to it, I think there's going to be economic value added. We're going to save tens and hundreds of thousands of lives from flu if we can actually be more careful about our behavior when it comes to contagious diseases.
Hey, Marko, it's Dan. Just kind of piggybacking on a little bit of what Guy just had to say here. I mean, listen, you've made your bones in this business being somewhat contrarian here. It seems that this call is somewhat consensus. We've been covering on the show over this week how just the way strategists have moved. You know, the way I see this right now is just we've been hit with a 100-year storm. You know, the worst health crisis the world has faced in 100 years, possibly one of the worst economic crises the world has faced in 100 years. Look at what's going on with federal debt to GDP all over the world here. And so you say to yourself, my goodness, there's just a lot of headwinds going forward. The stock market is probably the wrong lens to be viewing any success that we have right now with this crisis. So why stick your neck out with new highs, 3,600 by next year, when we just don't know what's going to happen here, if there's going to be other waves, other lockdowns. If there's another lockdown in 2020, it's lights out for the U.S. economy.
So 3,400 highs, not 36. Look, I think when it comes to current economic crisis, I agree with you. It's the worst that ever happened, but it's a sort of it's something that was ordered, something that was done, and it can be undone when the conditions are met. You know, when it comes to world health crisis in 100 years, you know, I would somewhat disagree. I mean, we had many sort of instances of severe contagious diseases over the past 100 years. You know, right now, you know, if we are at 133,000 deaths globally, you know, keep in mind 2017 flu was a large multiple of that. So it's a health crisis, and I think it's a health crisis because we don't know much about this virus. We're only learning as we go, and that's why it feels much worse than probably it is. When it comes to economic crisis, I do agree. Like, once when you shut down 100% of economy, that's by definition worst possible crisis it can happen. Economy goes to zero. So that's why I don't think that this is going to be something that we can sit on a historical data like 2008. I think this is very different, and it's very dependent on reopening it quickly, which I think will be possible. So I'm a little bit out of consensus on that one, more optimistic. And look, let's also mention that we do have unprecedented amount of fiscal and monetary measures around the world, so we shouldn't even neglect that as well as something that can help basically bridge this, call it cardiac arrest of economy.
Hey, Marko, it's Tim. So around the horn here, and I'll go back to the data that you at JPMorgan and your team crunch very well, and it's your data. Or at least it's market data. And I applaud actually the deep breath you guys took as a team 3 weeks ago and said, actually, you looked at equity ownership and you looked at some of the market positioning and said you actually were very constructive based upon those numbers. So where are we in the market? Because 3 weeks ago, we were at 1.5 to 2 standard deviations below equity ownership on a historical basis. We've had a big run back in, but how big has it been? And give us the market data, because that's what I think you guys do so well.
Sure. Absolutely. Look, we are not far. We are X of these, what we call quarter-end, month-end rebalances. So the first leg in the rally going into March 31st was basically pension funds adding, we estimate, about $170 billion of equities. You know, so that was an inflow, no doubt. But the hedge fund, if you look at the hedge fund beta, did not move all that much. You know, so hedge funds are still very, very underinvested. And these systematic strategies that we are basically tracking with volatility targeters, risk parity, CTAs, you know, CTAs closed a bit short, especially NASDAQ if you look at it, but they're still short S&P, you know, so positioning is still light, you know, and vol targeters, you know, those are people who basically invest based on inverse volatility, or call it inverse VIX, very, very loosely speaking. You know, they're still very much underway. They're pretty much close to the bottom. So positioning is still light. And that's also one of the reasons why we are positive here. So the only concern would be if the crisis lasts too long, you know, retail investors and citizens will need to dip into their 401ks. So that's the risk. If this lasts too long, you'll start depleting 401ks, which can produce some selling. But X of that, if we can get some better data, better sentiment, and if we can hold the levels here, eventually in the next few weeks you will see inflows from systematic folks, which can actually give us the next leg higher. You know, like so that's also one of the arguments why we think it's why we're still positive despite this pretty strong rally in the last few weeks.
Marko, it's Karen. Let me ask you something. Can you give us a little more detail on how quickly you will open? Do you think the economy will open? What kinds of companies? And how far away is it when we have packed stadiums or people going to concerts again?
That's a very good question. So I think we will start with the baby steps in a week time, and baby steps. I mean, you can look at Austria, Germany, Italy. They're opening some, limited clothing stores, landscaping, some construction businesses, very small mom and pop stores. So I think you'll see that. That's a small part. It's not big, but it maybe also helps the sentiment. Packed stadiums, it's tough to say. It's very tough. On that one, I would be a bit more cautious of cramming people with the same density as before. So on that one, maybe we're talking late summer, or maybe we are tying it to some of the more of these identification programs or treatments, if not vaccines. Keep in mind, the whole world is working on treatments. The whole world is trying to figure out the next steps on vaccine. Can you repurpose something old? Do you need to entirely come with something new? So on that side, I think news will get better. They're not going to get worse on that side, But again, cramming people in the tight spaces, I'm a little bit. Of course, that's going to be slower, and that's where we hope that sort of stimulus, both fiscal and monetary, can maybe plug a bit of that hole. That's going to last for a little bit longer than the initial reopening.
Yeah, let's not forget, Germany is slowly reopening small stores with physical distancing and no large gatherings till at least basically Labor Day, August 31st. So they're a long way off, although there are some baby steps. Marko Kolanovic, JPMorgan Chase. Marko, thank you very much. Do appreciate that.